Saturday, May 8th, 2021, Monaco 64, home of alternative economics and contrarian views. So it looks like, yes, the sentiment is improving in precious metals. Gold finally broke above 1800. Silver is looking very good. It still hasn't broken out some key technical levels, in my opinion, but it certainly looks like a breakout is very imminent. The fundamental picture is still not great for the world economies, especially the US. We had the jobs data yesterday. I'm going to talk about them. So am I excited about the gold price, the paper price at least, finally moving back up where it should go? And silver, actually for me, gold and silver, physical gold and silver provide peace of mind. And even though it's been frustrating the last 9 months or so, or however long it has been, I never had any doubt that gold and silver will protect my savings. What's exciting, though, I think is more on the mining sector side. If you happen to have gold and silver miners, I think they will do very well. And that's more speculation. Gold and silver is more safety, more insurance. You hope that you don't have to exchange your gold and silver, unless, of course, you find a very good opportunity. But right now, things are so crazy that I think you just want to have peace of mind. It's the only monetary asset, really, with silver that has no counterparty risk. And I think seeing what happened with Archegos, which is a hedge fund we didn't even know about. I hadn't even heard of it until all blew up. I think they're declared bankruptcy this week. There's 10 billion that creditors, and the big creditors, of course, are the banks. So do you really want to have a lot of your savings in the banks, these big banks? I don't think so. And even smaller banks, they're dependent on the big banks, so I'd be careful. So yes, I see gold and silver more as peace of mind. Did I get excited yesterday? No. I've been so disappointed in the past when I started out in '02 buying gold and silver. It's been quite frustrating seeing some of the shenanigans going on, that I try now to stay pretty balanced no matter what gold and silver does. I'm going to talk a little bit about what I've seen out there in terms of comments from officials. I'm going to look at the jobs data and what I think about it. And then we're going to look at some technicals. And I like fundamentals as well. And I look at the fundamentals. I worked for over 20 years in the financial markets as a broker. And I did both. Some people focus just on fundamentals. Some people focus just on technicals. I didn't see a reason why not focus on both. Gives you maybe a bit of an edge. And yes, I have been right about gold bottoming in March. And am I bragging? No, because I don't get it right all the time. Nobody does. But this time it looks like we are back up, and gold and silver are ready for takeoff. I think it's going to make it even harder to buy the real thing, physical gold and silver. We might see the premiums come off a little bit, but I think there's such a shortage. There's been so much manipulation that it's you're probably going to regret it if you didn't buy it in the last 2 months or so, because you're worried about the premium, because it's going to be even harder, in my opinion. So Twitter is an interesting platform, be as it may, in terms of whatever happens in terms of censoring. But I have a few followers and I follow them. They watch my videos. And I saw here Sia C's or Sia C's. I'm not sure how you pronounce the handle. She quoted or she tweeted here a comment from Yellen, retweeted from someone else. And it says, Yellen says she doubts we're going to see an inflationary cycle. Well, Janet Yellen doesn't know, of course, what inflation is, or she's just been dishonest because we've had a massive inflationary cycle starting last year with all the money printing. That's inflation. Janet Yellen as well is the person who said a few years ago, before the crisis last year, when the financial markets almost collapsed again uh, in March of last year, that she didn't expect to see another financial crisis in our lifetimes. Yeah, this is pretty good reverse indicator. So Cyace says, boom, the guarantee of inflation got gold. I agree with her. And then you've got Lawrence Leopard, who I follow. He quotes Yellen again. Yellen says pandemic has made clear families need more support. Well, how do you support the families? Well, more universal basic income. They call it stimulus, of course. And how do you get that money? Well, you borrow from the future. You indebt the nation even more. You indebt the people that you're trying to help even more. And it's not going to work. So there you go. It's going to keep going. It's going to keep going, unfortunately. And if there ever was a book I had to choose, if I had to, for example, leave my home and I could only take one book with me, it would be this one here, Fiat Money, Inflation in France. Not a very long book. I've had this book for about 20 years, and it's actually been instrumental in me understanding what's going on and what's going to happen in the world. And if you haven't read this book, I highly recommend it. I'm going to put a free PDF in the description, or you could buy the real book. I think it's worth buying the real thing. And you will see that the more things change, the more they become the same. It's an old French saying, actually. Le plus ça change, le plus ça devient la même chose. And human nature never changes, and we're making the same mistakes the French made in the 1790s when they started this stimulus as well back then. Money printing with the assignats. Every time it got worse, they pumped out more and more stimulus. And eventually the whole thing imploded. The whole currency collapsed. There was misery and poverty in France. Yes, a few people made out like bandits. And France was never the same and has really never been the same since then. France was a major empire, major nation until then. It still is today, but it really affected France, and it has affected France for over 200 years, that incident, fiat money inflation in France. That was, of course, during the revolutionary period in the 1790s. So I highly recommend that. And you'll see we're going down the same path. That's why it doesn't bode well. All the symptoms are there. All the symptoms that we've had of gambling in society, speculation, all the morals really going downhill, corruption, authoritarianism by government trying to control you. It all happened back then as well. And this will give you a really good insight into what you can expect. Of course, history doesn't repeat itself perfectly, but it rhymes, as they say. Sorry for all the cliches. But anyway, what about the jobs data yesterday? It's an interesting situation here because it was expected, non-farm payroll was expected to grow by almost 1 million. That was the forecast amongst economists. It was investing.com says it's 978,000, and it came out at 266. That's a huge miss. We also saw that the unemployment rate was expected to drop from 6% to 5.8, and it came out at 6.1. The only number that really was good for the worker, so to speak, was average hourly earnings. That was expected to rise by 0.1% month on month, and it rose by 0.7. A year on year, it rose by 0.3. It was expected to drop by 0.4. So it looks like we're having a little bit of a stagflationary environment. And I'm not saying that wages cause inflation. They're the consequence thereof. I think what's happening is the government, not only in the US, but everywhere around the West, they're making it so attractive for people to stay at home and not to work that employers are finding it hard to attract employees or labor, and they're having to raise wages. It's normal. And it's going to continue because, as you saw, Yellen says American workers need even more support. So I kind of thought, in my cynical mind, I thought, because the government, of course, the Bureau of Labor Statistics can tinker with that number. The Treasury, the Fed can get together before a number like that and say, what's going on? We need to keep interest rates low. We need to keep the yields, the bond markets under control. We need to give a boost to the stock market. What better way than bring out a number that's really weak and convince the market that the Fed is not going to taper again. It's going to keep providing liquidity, providing the inflationary monetary stimulus. And it gives the Treasury a great excuse as well to pass even more stimulus. And I think there's a little bit of truth to that. I can't prove it, of course. Or maybe the economy is just really bad, and that doesn't surprise me either. But I saw a tweet from Bloomberg News, saying that the jobs data, and this was right after the jobs data, the weak job data will give more ammunition for more stimulus. So I thought, wow, they didn't waste their time, right? So that's what I think is happening. And of course, we know, if you've been watching my videos and following me since 2016, I started right around the end of 2015, beginning of 2016, right when gold and silver were bottoming from their correction in 2011, of course. I've been saying that it's inflate or die. They have to keep inflating or die. And why have I been right about that? Well, because I've researched the past. I've read about history. It's not only this book, there are other books as well that have helped me, but I really recommend this one. So with that, let's look at the technical picture now for gold and silver. And yes, we start with silver because I think I found something interesting for silver, because the 30 level is on everyone's mind, of course, because we had the high last year, just under 30 in the beginning of August. And then in the beginning of February, with the silver squeeze movement, we touched that level, went just above it overnight US hours, or overnight London hours, from Sunday to Monday, February 1st. And we're focusing on this 30 level. But looking at this weekly chart here, I think we have a pennant. And what's a pennant? It's a consolidation technical formation. So what happens is you have a move, for example, from March last year when silver was crushed below 12, all the way to almost 30 in the beginning of August. It's interesting that the CFTC didn't try to maintain the integrity of the silver market when the silver price dumped from almost $20 to below $12 in a matter of weeks. They try to maintain, of course, as the CFTC head Benham just said recently, they were trying to maintain the integrity of the market when silver was trying to trade above 30. But when silver dumps like that, They don't care about the integrity of the market, but that's a different subject. So yeah, so we've had this move. That's the move we've had, right, from March last year to the beginning of August. That's a move higher, and this is the consolidation. The consolidation is the pennant. You can also have a flag, but flag are two parallel lines. A pennant looks like a pennant. And I think you might say, well, what about the spike in February? Well, I think that was maybe a little bit unnatural, even though I'm not trying to say that silver shouldn't be a lot higher. But as per the paper price, it looks just like a spike. So I think we can draw this pennant. And as you can see, we're very near that trend line, the top of the pennant. And once that breaks, I think all hell could break loose. And the reason why I'm saying this is that you might, or we might not even need to wait until we break 30 to see this really start motoring. Right now, that line last week was just below 28. And next week, it's going to be a little lower. It's pretty much where we closed this week. So I think we get above 28, it's off to the races, just like it's been off to the races in gold with the break of 1800, as we've seen in the last 2 trading days of last week. So usually these consolidation patterns, they work 3 out of 4 times. And what does that mean? Well, after the consolidation, the previous trend resumes 3 out of 4 times. So there's a very good chance that we're going to see silver go up as much as it did from the low last year in March to the high in August. And I extrapolated here, and it takes us to just below 50. And the move could be very quick, of course. So I think silver looks very good. So now let's look at gold. I've got a couple of charts for gold. I'm going to look at this weekly chart here. I spoke last week about this 1800 level here, that we had key resistance here because it formed like a triple top back in 2011, 2012, just around there. And then last year as well, in July, when we started taking off, after we broke that 1800 level, as you can see here, I've made a couple of a few circles here, 3 back in 2011, 2012, and 1 last year. You can see how gold took off last year when it broke 1800. And I said earlier this week the same thing, that if we broke through 1800, we could see a lot of stops, a quick move higher, and we did get that. Am I bragging? No. It's just looking back at history. It might not have happened, of course, but it has, and it just goes to show how important that level is. Yesterday, even though we went to 1843, the low overnight actually was 1802, so we even retested that 1800 level yesterday. We might do it again, who knows, with this market. But as you can see, we also have a falling wedge, which is another consolidation pattern, and it looks like we've broken out from that level comfortably. We've got this trend line here, which I've spoken about. I spoke about it in March or beginning of April when I said that gold looked like it had hammered a bottom. I mentioned the double bottom in the big that we had in March in gold, plus this trend line. So this trend line was really important. So now let's look at another chart of gold. It's a monthly long-term chart of gold since the early 70s, and it's logarithmic, so it smooths out the move. It's a percentage-based chart, and as you can see, there's still a lot of room on the upside, and the correction we've had since last year is going to look like a blip, in my opinion, eventually when gold starts taking off. And as you can see, it's a pretty good channel. We've got the top trend line showing us that there could be stiff resistance for gold around 2500. And it also shows us if we break that level, again, things could get quite wild. And as I said, it gives me peace of mind, because I think what this chart is showing is really the breakdown of the system, and it's not going to be funny. It's not going to be fun in the real world. We're already seeing a lot of people in trouble. The general public, the middle class getting eviscerated. And that's why the politicians are so concerned. That's why they want to continue the stimulus. But that's going to make it worse, just like it did back in the 1790s. And as I've said many times, look after your economy, your personal economy, your household. Try to hold on to as much silver and gold as you can. Of course, life is not just about money. There's other things as well. But unfortunately, this chart is showing us that things are not going to get better for the economy. I think we're going to have hyper or stagflation. We're going to have deflation. We're going to have a mix of all the worst things that we could ask for in terms of money and economy. We will get out of this storm and things will get better. And because I'm really optimistic, some people might think, oh, you're always talking about things, crises and collapses. But unfortunately, that's the course that our system has been put on. And I would say it's been put on for many, many decades. Even before 1971. I would go back to 1914 for the beginning of all these monetary, economic, and political troubles. And hopefully future generations will see a bit more stability. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Facebook, Twitter, and all these other platforms below here. I wish you all a great day. Take care. Bye.